in short, they'll get the cut. The juice is in the press conference. I think you can be fairly sure that QE is likely in our future. If not by the end of this year, then certainly Q1 next year. And then the game, I think, changes significantly.
In case you haven't noticed, the global monetary order is breaking down. More and more macro analysts are saying that the monetary system is in serious trouble, but what is causing this? What's the solution? What do investors need to know about it? And what is the Federal Reserve going to say at their FOMC meeting this week? Hello and welcome to Milk Road Macro, the podcast that knows that the best monetary system is the one that's set to direct deposit on your bank account. I'm your host, John Gill, and today is Monday, December 8th, and we are joined today by Grant Williams. Grant is a prominent macro and precious metals commentator with over 35 years of experience in finance across major global financial centers. He is best known as the author of the Things That Make You Go, newsletter, and as a co-founder of financial media platform Real Vision. Grant is one of the wisest minds in macro today, and he's going to be sharing tons of alpha and wisdom with us. So if that sounds good to you, make sure you like and subscribe, share this episode with someone who needs to see it. And as a reminder, our Milk Road Macro Pro Report just dropped. It's over 60 charts breaking down the crazy price action we've seen in the last month, what you need to know going forward. It's titled, There is No Need to Panic. So if you are feeling panicked, make sure you join our community, get in on that pro report there. The link is below in the show notes. Today's episode is brought to you by Reserve DTFs. Get exposure to the entire crypto market in a single token. Without further ado, welcome to Milk Road Macro. Grant Williams, how are you?
Hey, John, that was quite the introduction. Good to be here. Thanks for having me.
Yeah, I cover a lot of ground in my introductions. I thought a great place to start this conversation would be with what everybody's watching this week in macro, which is the Federal Reserve's FOMC meeting. The market's pricing in another 25 basis points cut. Are you expecting a rate cut, and what impact do you think, if any, this is going to have on the markets?
Yeah, I think they'll get another cut away this meeting, kind of through clenched teeth. You know, it's funny that I think Donald Trump has backed Jay Powell into a corner where he kind of almost wants to take the other side just to anger Trump now. I think if there's any way he could get away with it, with not cutting, he would, just to spite Trump. But I think they'll do it. I don't expect markets to react too much to that. But as always, you know, these days, it's all in the press conference. It's all in reading between the lines. It's always in the implications of what Jay Powell says and all those analyses of last comments versus these and the yellow highlighted changes and all this kind of stuff. The world fixates on it every time Chairman Powell gets up to the microphone, and things tend to unwind themselves in the next few days. What was interesting to me is, I don't know if you saw Jeff Gundlach was talking a day or two ago, and he talked about how he figured that when we get to 5%, bond yields, then he expects QE to come back, and he expects the Fed to be buying all kinds of bonds, and he's expecting another blow off top. You know, I think he could be right. Actually, I think he might have said 6%. I think my friend Steph Pomboy agreed with him, but said she thinks it's 5% in typical Steph fashion. So, but I think the important thing for investors there, or more importantly, really for traders rather than investors, is this idea that QE is most likely once again in our future. And while if we get it, it's not a good sign. It means the economy is floundering again, despite all the trillions in stimulus that's been thrown at it. The economy still needs some kind of juicing. It'll be good for nominal stock prices and nominal bond prices in the early action after that kind of introduction of QE again. But again, I think this time around, we might start to see people look beyond the actual nominal price prints, look beyond the headlines and try and really understand what this means. And I don't think any of it's good. So yeah, I think in short, they'll get the cut. The juice is in the press conference. And I think you can be fairly sure that QE is likely in our future. If not by the end of this year, then certainly in Q1 next year. And then the game, I think, changes significantly.
Yeah, I really appreciate the thoughts on that. I'd like to ask some questions around this balance sheet expansion. And, you know, you said that you think QE is somewhere in the future. A lot of people are speculating that the Fed is going to be buying T-bills, and QE, just for the audience, is traditionally understood as being like buying the longer end of the yield curve. But people are thinking that they're going to be buying much shorter dated bonds here. Do you think there's what are your thoughts on this difference in policy? Because it seems like the Fed is trying to do what they call non-QE, QE type of things with this. We just, without maybe wading too much into the weeds there, because nobody really knows what Powell's going to say or do. But what are your thoughts on this change in policy? What does balance sheet expansion look like for the Fed in 2026?
Well, I think the common thread of all these various iterations of quantitative easing or unconventional monetary policy, to give it its euphemistic title, is that they've done what they've had to do. They've stepped in and they've bought what needed buying, and they'll do that again. And obviously, there's an enormous concentration in the front end of the curve, both in terms of outstanding issuance and what they need to issue again. So it might well be that the Fed is forced to step in at that end of the curve. I mean, I don't know what they're going to do, and I would suspect that they probably don't either. It's going to depend on what needs support when they actually realize that they're going to have to step in and support the market again. So nothing would surprise me at this point. Nothing. There's we've been through various stages of this. It's like the 7 stages of grief, where we never thought for a minute they would buy anything but the long end, and we never thought they'd buy mortgage securities. We never thought they'd buy, commercial bonds. We never thought the Japanese central bank would buy ETFs. And one by one, they've broken all of these rules and they've done anything that they needed to do. And that's, again, it's a telling sign. The fact that they're doing what they need to should tell people something, that without that support, without the Fed stepping in, wherever it is they choose to step in, there are problems there. And whilst Fed activity and Fed interference and then putting their thumb on the scales can change things for the positive in the short term, we're back again where we were in desperate times with the Fed being relied upon to save markets. And there is a caution underneath that I think people would do well to pay attention to.
One of the consequences of all of this intervention from the Fed and from other government actors has been a shaking of the foundation of trust that people have in the global monetary order. You've highlighted this a lot in your analysis, and you specifically highlighted the sanctions on Russia that were placed as sort of like a crossing of the Rubicon, where the monetary order took notice and was really shaken. Walk us through what was the damage and the impact of this, and what has the fallout been so far, and how is that continuing to play out?
I think the damage is significant. I do. I think it was a dramatic misstep on the part of the U.S. Treasury in sanctioning Russian central bank assets. And for those who aren't aware of what happened, which is remarkable that there are plenty of people out there that aren't aware of it. After Russia went into Ukraine, the Treasury froze the Russian central bank assets in SWIFT. There's about $300 billion of assets in SWIFT, dollar assets, and basically stopped the Russian central bank having access to the country's reserves. And, there was a lot of praise for them doing that from Europe, as Europe tends to do. But the simple truth is this, and I wrote about this at the time, the day I read about it, that by doing that, you are completely and utterly undermining trust in the system. And in a system that is based on the dollar, if any central bank which holds dollars, which is to say every central bank in the world, because of course it's the energy currency, so everybody either receives or has to pay out dollars for energy, you have now crystallized the idea that there are a set of circumstances under which the US will unilaterally decide to freeze you out from your sovereign assets. And that's not a chance you can take. You might be the greatest friend in the world to the United States right now, but we've all seen pictures of Putin shaking hands with presidents past in the US, and there was no problem there. So every central bank in the world is now on notice that we don't know what they are, but there are conditions under which you could have the same thing happen to you. And that's a national security imperative now. So what you've seen in the last couple of years is utterly predictable, which is central banks trying to lower their dependence on dollars and switch out of US treasuries into gold. Gold obviously being a neutral reserve asset, a truly neutral reserve asset that they can own under their own auspices in their central bank, free and clear of any encumbrance from another country. And it's happening. It's happening dramatically. The central banks have bought over 1,000 tons each year the last 2 or 3 years, and I fully expect that number to be matched or breached again this year. And I suspect that'll continue into the next year because as treasury holdings roll off, they're less inclined to recycle them and buy new issuance, and they'll just let that money come back and switch it into gold. So they've really, I think, shot themselves in the foot, the Americans, by doing that. They've given a reason for other central banks to find alternatives to being stuck within the dollar-based system. And those other countries are doing that. And that's kind of music to China's ears as they try to build a competitive system. And, I think that the results are clear to see. And I don't expect now the direction of travel to change anytime soon. That there has been a rupture in the monetary order. There's been a rupture in, as you pointed out correctly, the trust placed in not just the dollar, but in the stewards of the dollar-based financial system, which is the US Treasury. And once that trust is broken, it's very, very difficult to get it back.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on-chain. We need a crypto-native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer.
I do want to ask some questions about this alternative order and how gold is benefiting from this, but I want to stay on this idea of trust and faith. The current monetary system is colloquially referred to as the central banking fiat system. Fiat comes from a Latin word that means faith. Is there anything that you could see happening or a policy path that could be pursued in your mind that might restore that faith, that confidence, and sort of bring back the global system to the dollar-based and U.S. debt-based system?
Well, look, you can never say never. I mean, nothing's absolute. But right now, I think that the misstep here is that until 5 years ago, 6, 7, 8 years ago, if you'd have forced any of these countries to pick a side with America or another, whether it be China, whether it be a block of countries, it would have been a fairly sensible and safe choice to immediately pick America. And I think America knew that, and I think America relied on that. And I think America believed that that wouldn't change and that these countries were staunch allies and they would remain so. And of course they would until they either get treated poorly or they see how other people are treated and they think to themselves, well, you know what, that could be us. And that's the big change here. This idea of faith and trust in money, the fiat money, as you say, faith-based money, the faith has to extend to the issuers of that money and the stewards of that money and the people whose financial system or within whose financial system that money moves around. And I think some grave damage has been done to trust in the dollar, trust in the United States, and trust in the dollar-based monetary system. So, time is the answer. You better hope that people aren't forced to make that same choice I described earlier in the not too distant future, because the nearer we are to this, the harder choice it's going to be for people. The more time the United States has to perhaps reinforce those alliances and reaffirm the trust that people have placed in them, the better they have. But I think, at the same time, you've got China now seeing a moment to perhaps tease some people out of the US's orbit. And of course, for countries like India, this is fantastic. They're playing both sides brilliantly, as they should. They're trying to get concessions out of both sides and doing a remarkable job because they're such an important country to have inside your tent. Same with the countries right throughout the Middle East. I was in the Middle East a couple of weeks ago, and there's heavy Chinese evidence in the Middle East, and they are making an aggressive push to become more prominent in that region. And they're turning a few heads. I don't think at the moment it's anything other than, as I said, the middle playing both sides beautifully like a fiddle. But if you're forced to make a choice, at a time like this, you're more inclined to choose who you think is going to be stronger in the future than who has historically been strong. Historically, it's been the United States, unequivocally, but people might start to reweigh that calculus and make different choices going forward.
Gold has benefited a lot from all of the things you've just described in this answer. And I want to kind of drill in on this asset and why it's specifically benefited so much. You said in a recent interview that gold is money, everything else is credit. And I thought that was a really great way of capturing this.
I didn't say that. JP Morgan.
Oh.
JP Morgan said that. I'd absolutely. I wish I'd said that. No, JP
okay, I
Morgan
guess you were quoting JP Morgan then.
Yeah. Back in the early 1900s, he said that.
Okay. Well, I would love to hear you elaborate on that point. Why is gold money and everything else credit? And why is gold becoming so important and benefiting so much from this change in the monetary order?
Well, gold is becoming important again. And I think that's really an important word to add, because gold was the foundation of the financial system for 200 years. And there were periods where we were off a gold standard. Wars when governments needed to loosen the purse strings and print money to effectively wage war in 1914, particularly, and obviously the Second World War. But for 200 years, the world was on some kind of either gold or bimetallic gold and silver standard. And what that did was it restrained the ability of countries to overpromise and overspend. With the welfare society in the 30s, the pressure began to try and make more promises and spend more money that countries didn't have. And eventually the gold standard didn't work under those conditions. And so the gold standard was finally severed in 1971 by Richard Nixon. And the deal has been since then, look, you have to trust us that our dollar is money good. Before that, it was always convertible into dollars at the state level, at least, not necessarily the man in the street. But of course, in the 1960s, Charles de Gaulle and the French decided that they would rather own the gold than the dollars, and so they were shipping their dollars back to the United States and demanding the gold. And for a few years, the US was shipping the gold to them until they realized that there's a path here, and we are heading to having a lot less gold than we think we need. And so Nixon severed the link, and from that point on, it's just been a purely fiat dollar. There's nothing backing it. And it's worked great. It's worked really, really well. As America has promised and spent more and run up these huge deficits, the world has been choking with dollars. We've seen rates come down. We've seen stock markets go higher. We've seen house prices go higher. We've seen every kind of asset go higher. But a lot of it, of course, built upon debt. And when the debt gets too big for the system, and this is what the gold standard would never allow. It would never allow these imbalances to build up, which is why things were much more stable under a gold standard. They just didn't have the expansionary capability that this purely fiat system has. So my belief has been for the longest time that we would go back to a gold standard of some sort, even if it's just pro tem, as a stabilizing mechanism when fiat currency is no longer trusted and trust breaks down in that system. You need something to reestablish trust. And realistically speaking, I know the crypto crowd would like that to be Bitcoin. And maybe in a few thousand years it will be. I mean, I'm not saying it won't be, but right now, unfortunately, the same way that people are making decisions around wanting to own gold at the state level, we haven't seen a lot of central banks dashing out to accumulate Bitcoin in the wake of what's been happening, because it doesn't have the track record gold has. Maybe one day it will be. I don't know. But again, with irreplaceable capital that you can't afford to lose, gold is a sensible way to mitigate a lot of that risk. I just don't think Bitcoin is right now. So that's what central banks are doing. You know, they're lessening their exposure to US dollars and other fiat currencies as well, but mostly the US dollar because they're so overweight dollars. And they're replacing it with gold, which, as I said, is a neutral asset, and it's nobody's liability.
I'm really curious your thoughts on how this looks going forward. We're seeing a return, as you've said, to a millennia's-old financial technology instrument, which is, this yellow rock, gold. At the same time, technology and artificial intelligence are pushing things to places they've never been, and we're hearing people say things like we're at the end of economics and capitalism as we know it. How do gold and AI coexist in the future economy that we're heading into? Do they benefit each other? Does a replacement like Bitcoin come out of that? Or like, what do you see as that intersection? What does that look like in your mind?
Well, we'll find out. I mean, we don't know. Technology moves so fast, we don't know. But again, you were right to point out the importance of trust. And, whilst a certain segment of society have placed all their trust in cryptocurrencies and Bitcoin in particular, the vast majority of people aren't there yet. The vast majority of people in India, for example, wouldn't look twice at Bitcoin. They would much rather have gold because it's been something that they've seen their grandparents and their great-grandparents and their parents save in. And it's familiar, it's trusted, it's a proven store of value, it's a proven protector of purchasing power. It's all the things that people want when a fiat system crumbles. And as I said, well, I don't know of Bitcoin's future, but right now, apart from the group of people who own Bitcoin, if the financial system crumbled and you said to every single human being on the planet, look, I can give them a Bitcoin or some gold, the vast majority of them are going to want gold because they have a frame of reference with it. They probably know someone that gave them a gold coin when they were younger, or they saw someone that saved in gold, or there's just much more reliance. And when it's an issue of trust, which it seems to be moving towards, you trust what you know. You don't really trust technology. Gold has survived the internet. It's survived all these other technologies that have come out, and I fully expect it to do the same with digital currencies. Their future is much cloudier, because we can't look back as far. I think it was Churchill that said, the farther back you look, the further forward you can see. And you can look 6,000 years back with gold. You can look 16 years back with Bitcoin. So I think, I'm not making any proclamation about the future, but I know for me, there's only one of those two that I'm going to trust in a situation where trust evaporating is the problem, and it's most certainly gold.
Yeah, and I think that there's a strong thesis there. I think it's important to be aware of that. And just like you said, we'll see what happens. We're not sure what system AI and AI agents are going to place their faith in, or what they're going to trust, or what that's going to look like. So, okay, let's get this into dollars and cents here.
Just to interrupt that, another way to think of it, you know, I watch with interest / amusement every time I see Michael Saylor talking, and you know, last week he released his 21 commandments of Bitcoin or something. I'm not quite sure what it was all about. But one of them was, you know, you only put into Bitcoin money you can afford to lose. And I think if gold, you put into gold money you can't afford to lose. And when the system shifts from risk on and low rates and everything's, we're going to 5x, 10x, 20x, that's what you put in money you can afford to lose. When trust breaks down and the system starts to quake, and we get a reorganization of how the system works, it's about money you can't afford to lose. And so that, I think, is gold's time and not necessarily Bitcoin's time.
How high is gold going to go? It's trading now at around $4,200. Where do you have a target on this? Do you have a timeline, or is it just you think this is just going to continue into the future indefinitely?
I don't. And to be fair, anyone that's seen me talk about this for the best part of 20 years, I've never, ever talked about the price of gold, because the distinction I made early in my time of looking at this was that there were two prices. There's the gold price and there's the price of gold. And the two very different things. The gold price is what you see quoted on a Reuters screen, and that is based on a paper contract on the COMEX. It's not, you know, it's the price of a piece of paper that represents ownership in gold at some future date. The price of gold is the money you have to hand over, the fiat money you have to hand over to put a 1 ounce gold coin in your hand. And they're two very different things. And the price of gold traditionally trades much higher than the gold price, because there's an extra added value to having possession of physical gold rather than a claim on it. And I've been very studious in not talking about the gold price, because I think when people look to make forecasts, that's totally fine. If you're looking to trade gold in and out, that's fine. You know, you're looking at charts and you think at 4,000 it's a sell, and you buy it back at 3,500. I totally get that. Or you think at 4,000 it's going to 6,000. I understand that, but that's never ever been the way I've approached gold. You know, gold for me has been a means of protecting my purchasing power over time, and it's done a phenomenal job of that over the 23 years since I first bought my first ounce of gold. It's more than protected my purchasing power. And so I don't look for the price of gold as to think where it's going and what I'll do with it. It's what can I exchange it for that I want to own more at a given point of time. And so the best example I came out with when I gave a presentation about this last year was I looked at the median house price in the United States, which was up 50% from 2003 to 2000. I forget the date I chose, 2020, I think maybe. But in ounces of gold, it was 74% lower. So yeah, if you had 100 gold coins in your bank account, in your safety deposit box, regardless of the price is irrelevant. If you had 100 coins that equated to the median house price back in 2003, and you went to buy that median house price today, even though you'd have to pay 50% more for it in US dollars, you only had to take 25 of your coins out of your safety deposit box and get the same house. And so it's not about the price to me. I know a lot of people it is, but I'm not someone that looks to trade gold because of the price. I want to own it to protect my purchasing power. And then one day there's going to be something that I feel has fallen in price dramatically, and I can exchange my gold for that, which I want to hold longer term.
The importance of protecting and preserving purchasing power and economic capital like that. It's everything. And it's something investors, I think, are starting to become more aware of in this high inflationary environment we've been in. Coinbase did an ad for Bitcoin around that same idea about how much Bitcoin it takes to buy a house. So just that mindset shift, I think, is really important. And I do think, it's worth calling out that consistency you've had across your career about not focusing on the day-to-day price, but the longer view of the asset. That's the investor mindset that I think is something I'm trying to highlight on this channel. So I appreciate you sharing that with our audience. We're coming towards the end of time here. We're coming towards the end of the year as well. I'm really curious to hear your thoughts on what surprised you the most in 2025. This was a year full of very unusual things in the market. What was the most surprising thing that happened for you in the markets, or what stood out to you the most this year?
Boy, it's a great question. This is where the audience realizes that we didn't agree these questions beforehand.
We're live, folks.
Yeah,
Watch
exactly.
Grant think in real time.
No, I, to be honest, I think there's a couple of things that surprised me. The first has been the fact that this whole thing has stumbled through another year. It looked last year like things were starting to get a bit shaky. We saw the AI bubble come in and kind of rescue things and bring in a load of attention and bring in a load of speculative capital and kind of keep the party going. As we come into the end of this year, that AI narrative is finally starting to be questioned. And people are starting to look at the assumptions for OpenAI and look at the revenue projections, look at the valuation projections, and kind of scratch their heads and start to think, actually, you know what, this feels a little far-fetched. So I've been surprised at how much of a rising tide that particular corner of the investment market has proved elsewhere. Though if you dig into the numbers, you'll see that the stock market has not been anywhere near as strong as perhaps the headlines would tell you, given the impact that the Mag 7 and the AI stocks have had. I think going forward into next year, we'll see. I think there's a day of reckoning coming. I'm surprised it hasn't happened this year. I'd be very surprised if you and I had this conversation in December of 2026 and we hadn't seen a material correction in markets. That's not to say that Jeff Gundlach isn't right and we could see a blow off top first, but I suspect strongly that if we do get a blow off top, it'll be a very short, sharp spike. I think anyone that was around for the death throes of the NASDAQ bubble, the dot-com bubble, for those who were around for the death throes of the commodities bubble going into 2008, you'll recognize that parabola when you see it. And hopefully, if you were around for those two, you realize how quickly you have to get out and how quickly you have to recognize a top of this nature. And, in my mind, it's always good to leave some on the table. It's okay when markets perform the way they have, the FOMO you have in getting that last 10, 15, 20% out of the kind of run that we've had. You've got to be a hell of a trader to nail the tops of blow off tops like this. And I would suggest that there are, whoever you are, me included, everybody, there's a better trader out there than you. And so don't let the success that we've all probably had in these last few years trick you into thinking you're the greatest trader in the world, because you're probably not. I know I'm not, and I'm definitely not trying to time the top.
That's a lot of wisdom in there. I was going to ask you if 2026 is going to be bullish or bearish, but I think you kind of already answered that.
Well, I think
your
both.
Thoughts on that?
I think both, and
Sure.
it's actually really important, John, because there will be a time to be bullish and a time to be bearish. And the only thing I would say is that if you're bullish, don't be blindly bullish. Don't just think, everything's going to go higher. This is going to be another bumper year. It might do, but the two things that are different, the chance of everything going up this year is lower, and the damage, if it doesn't and you're wrong, is potentially much higher. So I gave a presentation earlier this year, and I walked through the last 4 decades with the audience, and at the end, I asked for a show of hands to the question: given everything I've shown you, it really should have been the easiest thing in the world to make a lot of money these last 40 years, and no one in the crowd could disagree with me. But that's because of massive tailwinds, coming from every direction, just pushing you one way. Those tailwinds, I suspect, have turned into headwinds. You might not be able to feel them too much now, but they're there. And the most obvious one is inflation, and people need to pay very, very careful attention to inflation this next year, because if it starts to gain traction again, and I think it will, it changes things in a hurry. So that the quantum of being bullish and wrong is massively elevated for this year. So just, I'm not saying don't be bullish, I'm just saying be very, very careful about being maximum balls to the wall, eyes closed, grab everything and hang on for dear life bullish.
I think that's good advice in any circumstance. Yeah, and I very much agree with that. I think one of the goals of Milk Road Macro is to focus on education and not being dogmatic about what must happen, but taking in new information, learning from a lot of different points of view and information from the market, and just kind of responding to what does happen. Grant, I really enjoyed this conversation. I feel like there's so many more things I could ask you about, but I think the thing I want to like have the audience take away from this is that Grant has been in this for 35 years and has stayed a student, is always updating his views, and is willing to adjust on the fly. So that's a great lesson there. Grant, where can we send people to find more of you and your work online? You've got my Twitter handle there, I see. Thank you for that, at TTMYGH. And I've got a website, grant-williams.com, and anything you want to know is all there in one place. I want to ask you, I usually don't do this after that question, but I'm asking you one more. Your newsletter is called Things to Make You Go, Yeah. What are some things right now that are making you go, what, like, other than what we've already covered in this conversation, is there anything top of mind that's making you scratch your head and think right now? Well, interestingly, given where we started, I'm just in the process of writing my next piece, and it's about this this competitive financial system that's being built by the Chinese / BRICS countries. So that's something that I think is going to be important going forward. I wrote about unemployment. I wrote about the first brands collapse. There's the beauty of these markets, and sadly it's 40 years now, not 35. There is always something to, I've been writing this letter for 16, 17 years now. And I've never once sat down to write about it and had to think, oh my God, what am I going to write about? It's always, okay, which of these 5 things shall I write about this month? And it's always a thing that just interests me the most, and there's never, ever a shortage of things to be curious about. And, a lot of these things, they interact and they change the way markets function, and they change the way investors behave. So it's a wonderful time to be alive, John. I tell you that much. It's a wonderful time to be alive and a wonderful time to be on Milk Road Macro. Grant Williams, thank you so much for being here. Thanks for having me. I appreciate it, John. Take care. Absolutely. And thank you all for joining us. I hope that you all learned something today. So until next time, stay safe, stay educated, stay bullish, and we will see you all on the next episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.